We are almost live. Almost. All right. Can I ask somebody to give me a sound check? Is my coming through okay? Por favor. Okay. Wow. Lots of comments already. All right, let's do it. Westlaw, same here. September is a negative month. Yes, for stocks and trying to see if there is something positive just in case. Franklin, hello. Westlaw. Hey, Bob. Thank you, Seymour Rivers. Devin, hello. Loud and clear. Thank you. Thanks, Franklin. Appreciate it. Okay, we have our earnings that we traded today on two stocks. They both announced after hours, Broadcom and Lululemon. Pete, hello, welcome aboard. And we're going to talk about those two trades, how they're working out for us. So let's get to it. The way we traded these trades is that we sold premium, meaning we sold options to generate cash flow. We did not buy the options. So as option sellers, we don't want the options to move. We don't want the stock to move. So that makes us money. All these options expire tomorrow. So let's get to it. Oh, I didn't send out the goddamn link. No, I was wondering why there aren't a lot of people. I forgot to send out the link again. I have members that are requesting it. This is the second time in a month I did this. Or did not do this, I should say. Pardon me, folks, while I get this link out to at least our members community. It's a little bit late to send it out by email. But hopefully they click the link below in the notification bell and that's for Lewis. Okay. All right, so sorry about that for folks that did not get the alert. Okay, let's do this. So we traded Broadcom. And by the way, again, going back to the way we traded it, we don't want the stock to move. The least movement that it has, the better it is for us. Now, it's a mixed bag tonight of how we're doing. Both are at current profitable, but tomorrow you really know. So when we take a look at Lululemon, was the first one up. What we did here is that we sold, what do we sell? The 235 puts and the 325 calls. So they had good numbers. The shares are moving higher in the after hours session. Our strike is a few points below. We're probably going to get challenged at that strike tomorrow. We'll wait until late in the day to see whether or not we're going to close above 325 or do we close down below 325. If we close down below 325, we collect 100% of the premium. Now, I'm going to end up rolling up the put side as well to try to generate more cash flow and increase our basis cost. Excuse me. Increase our premium. Sorry, increase our premium paid. So why am I confident about Lululemon? Simple. All you need to do is take a look at where you have resistance above. Now, the stock is not reflected in the after-hours session on this chart, but you can see up here in red, we have a lot of resistance above that mark. So 323 is our price target. We traded just shy of that this evening. I think that we're going to hit it tomorrow. If not, go up above our 325 mark. It's going to be a matter of patience, seeing whether or not it holds that level. I'll probably roll up our puts early on to around probably around 300, 310. And if necessary, open up a straddle, meaning roll up the put side to the 325 strike price, creating a straddle and taking a lot more premium. And if necessary, we just roll out of the trade. We're not going to be short the trade on Monday, having the shares assigned to us or nothing like that. We don't want the shares. We just want to generate cash flow. So that should work out well, but we won't know until we're out. We also traded Broadcom. This one here is looking far more easy of a trade to manage. On this trade here, we sold the 450 puts and the 535 calls. Now we're trading up in the after hours session. Last tick was 502. The high was around 506, 507. So we're way up here, right? Our strike has got to be way up here to get challenged. I think we're good there. No real worries. But again, you never know. So once we're out of the trade or the options expire worthless, then we don't worry about it anymore. Until then, we remain on guard with our position. So those are our trades. We're feeling good about them. No more earnings left to go this week. In fact, it's probably it for the season. And now we're going to be looking at Tesla numbers coming up soon. All right, so let's get into it. Tonight's commentary is with regard to the stock market crash 2022, and have we seen a bottom? We saw a lot of volatility today, meaning swings lower, higher, then lower again. So is the bottom in? Have we seen a bottom? I think that in a very, very short-term basis, yeah, we're probably feeling out a bottom here. We're going to go to the weekly charts in a moment, but I think that longer term, the trend is clear and defined, and we're going to go down lower. We're going to talk about Jeremy Grantham and his prediction for the stock market bubble. Jeremy Grantham is one of those investors that I respect, one of the very, very few that I respect, because he's been so dead on so many times, and you just got to tip your hat to the guy. So we're going to talk about an article that either he typed out or was interviewed, whatever. So one of the first reasons why I want to talk to you about the market not yet being done going down is it's simple. Stocks are expensive. This is an Achilles heel. I don't believe that in an economy that's expanding, increasing 2-3%, you really need to worry about valuations all that much, because things are going well. It's when things begin to deteriorate, that's when you got to worry about valuations, because companies need to justify, hey, why do I need to buy you at these prices? You got to worry about that. So this is an Achilles heel of the market, and we go over this every Sunday night, and I'm going to go over it every Thursday night as well. The Buffett indicator did come in some this past week, but we remain overvalued. We are currently 36% overvalued relative to historical trend down here in black, or one standard deviation. Now, we've come in dramatically since the highs, but yet we still remain overvalued. Isn't that strange? We, at one point in time earlier in the quarter, we were actually twice fairly valued. But what happened? Earnings were guided down last quarter. Earnings met, sometimes exceeded, sometimes missed. This past quarter wasn't a great quarter. And so stocks at lower prices are still very expensive. So when we take a look at a chart of the S&P 500 or the Tues, we just covered our short today on the Tues. For all of you that mocked me out there, how dare you? Here's the weekly chart of the Tues. Let's go to a monthly chart. Yeah, monthly chart. You know, we've pulled back quite a bit here, but folks, we're flagging out. This was a bear flag setup. This was the summer rally. What did we do today? First day of September, we gapped down below the lower band of this support level. We just flashed today a continuation breakdown on the triple Qs. Now, granted, they did manage to rally back on the day to close positive. We covered our shorts early on in the day. We had book profits on our put position. We were also long on the SQQQ, which is a leveraged ETF, putting you short of the Qs. We closed out that position early on today, and I'm glad we did. We're probably going to get a short-term bounce here on the Qs. But longer term, folks, don't take your eye off the macro view, and that is this chart here. You are here. You are now down below this lower band of support. Not a great place to be if you're bullish. Now, economic data, which came out this week, we're going to skip this. Not a lot of new data, with the exception of the new ADP report. And that really missed, man. That missed by a mile. And this is supposed to be more correlated now with non-farm payrolls. This is the first report we've had since May on ADP. So tomorrow we're going to get non-farm payrolls. Remember, bad news is good news. Bad news is good news. If you see non-farm payrolls miss, stocks are going to rally. What could hamper that is a rise in average hourly earnings. If you see average hourly earnings fall, that's bad news. Stocks will go up, as sick and perverse as it is. Why? The perception is the Federal Reserve will not have to raise rates as aggressively as they've been talking about. So it'll be short-lived. So don't get too used to it. We may also get a short covering rally going into the weekend. Remember, it's a long weekend. It's going to be light volume by and large tomorrow. Typically is on the Friday before a holiday weekend. So probably a lot of volatility in the morning. The markets go to sleep in the afternoon. Simple as that. People going out to the Hamptons. That's just the way it is. Markets are closed, as I see, by Seymour Rivers on Monday. Yes, sir. All right. So let's go to a quick synopsis. This kind of summarizes where we want to go with the next topic about the phases of a bubble bursting. This is my third one. So I think this kind of summarizes it pretty well. Let's make sure my volume is up here.
So, what you're telling me is that music is about to stop, and we're going to be left holding the biggest bag of odorous excrement ever assembled in the history of capitalism.
Sir, I'm not sure that I would put it that way, but let me clarify, using your analogy, what this model shows is the music, so to speak, just slowing. If the music were to stop, as you put it, then this model wouldn't be even close to that scenario. It would be considerably worse.
All right. So let's bring up a chart of the S&P 500. It's the benchmark, so we'll use it. Okay. So here are our phases. And we'll refer back to this from time to time to get a feel for where we're at. All right, so prepare for an epic finale. Jeremy Grantham warns of a stock market super bubble has yet to burst. A little bit of background on Jeremy Grantham. Many of you may not be familiar with him. He usually only gets quoted when things are about to go real bad, real quick. He infamously spotted and profited from bubbles in Japan in the late 80s, tech stocks at the turn of the century, and in U.S. housing before the 2008 financial crisis. You had a typical bear market. He's referencing the market rally of the summer. Not that it's still not the summer, meaning June through early August. You had a typical bear market rally the other day, and people were saying, oh, it's a new bull market. And he said that is nonsense. I agree with that. And I was saying that a few days ago, and I was kind of happy, and I never outed the guy. I could always print up his comment to me when I went short of the market, the Tues anyway, a few weeks ago, and he left me a comment on YouTube, and he said, basically, good luck in Chapter 11. I'm not sure if that's restructuring or complete bankruptcy, but I get it. I got his gist. So he was married to his positions. He was married to that bear market rally, which I knew what it was, but to him, he was invested, meaning emotionally invested. And I've mentioned this. And when I see that, to me as a contrarian, that tells me that you're probably right on your call here. So I stuck with it. And ultimately, it worked out very, very well. The 83-year-old investor says that the surge in equities from mid-June and mid-August fits the pattern of a bear market rally after an initial sharp decline. Absolutely correct. Absolutely correct. Here's 2000. The NASDAQ. We'll go to the NASDAQ. Here, sharp decline, counter trend rally, right? Let's compare apples to apples. Not so sharp as decline, but a counter trend rally. This rally here was 25%. This rally here was 39%. So this is where retail gets sucked back into the market. Institutions did not, because remember, we were going up on light volume. Institutions knew. They've seen this playbook before. Moving on. The bubble forms. Okay, these are the stages of a super bubble, right? The bubble forms, right? So here you have it. Great times post-COVID, lots of money getting printed. The bubble is blowing up. Nobody cares about valuations. Nobody. What did I just do? Oh, here we go. Second, the setback occurs. That's that first sell-off from June into the, from April. When was it? When did we peak out? November, we really peaked out. We bottomed out in June. So that was the first sell-off. As it did in the first half of the year, with some wrinkles in economic and political environmental causes, investors to realize that perfection will, after all, not last forever, and valuations take a half step back. And they have. Valuations have taken a half step back. But people perceive that lower prices in the stock market means stocks are less expensive than what they were a few months ago. That's not the case. Lower prices does not mean a cheap stock. Lower prices means they're not making as much money as they should. The market is deteriorating around them. Borrowing costs are going up higher. People aren't buying as much. You're seeing inflation eat up people's buying power. Their businesses are eroding. So the ice is melting underneath their feet. So what appears to be a stock that is well off of its highs, like NVIDIA, I was trading options on it at $300 a share. I wouldn't touch NVIDIA right now. I love the company, but I can't touch it right now because environmental factors are at play. Now you have, they can't ship chips over to China, certain chips over to China. That's a problem. That's the U.S. government getting involved in their business by fiat, by mandate. So it's, to me, it's uninvestable. I love the company, but I can't buy it. Then there is, well, we have just seen the bear market rally. Okay, that's the June to August rally. Fourth and final, fundamentals deteriorate and the market declines to a low. Now, this is where things get interesting. So when valuations matter only when they matter, meaning you're seeing the market go to hell in a handbasket, and all of a sudden the talking heads on CNBC, Fox Business News will come on and say, oh, you know what? Stocks haven't been this cheap in 5 years. Well, they were expensive back then. They're still expensive now, and they can go lower. Talk to me when equities on the Buffett indicator are trading down below this historic trend line, the fairly valued trend line, down one standard deviation, two standard deviations below that trend line. And then we could talk about having a bottom in there. If you're not going to show me those types of prices, I'm not an investor. I'm not looking to dollar cost average into this market. I'm too old. If you're young, dollar cost average, you got plenty of years. So what are the problems out there that are going to send this market lower? We come here, I come on here every Thursday night, every Sunday night, and we talk about the same thing pretty much over and over again. The reason is that as a macroeconomic guy, you know, macroeconomics doesn't change all that much. You see a massive trend emerge and it sticks for 5, 10, 15 years. So we had a deflationary environment that's now turned into inflationary environment. We had a tightening period for well over 20 years. Excuse me, an easing period that lasted for well over 20 years. Now we're in a tightening period that could last 20 years. So these are just a few of the issues that are going on. Near-term problems, food, energy, fertilizer costs. Folks, this is all self-inflicted. Everything here is self-inflicted. We did this. We did this, meaning the West, the Europeans. Europeans are the most, either they're corrupt or they're the most stupidest, meaning not the people, I'm talking about their government. The stupidest people on the face of the planet, or they just don't care. Either way, they're nefarious and they got to go. Same thing with our rhinos in Washington, D.C., and these liberal Democrats in Washington, D.C., they got to go. Not by revolution, not by force, by the vote, fair vote. They got to go. They got to leave. Also, China. China, which bailed the global economy out of the financial crisis. Don't forget that. It was China's economic growth that bailed out the rest of the globe. They took advantage of it. We're paying the price to this day, but it was China. China's not there anymore. We're lucky if China is still growing at this point. Tightening. We're in a tightening period. As much as the Federal Reserve wants to proclaim they're being very aggressive and taking it seriously, they're not. But God forbid they wake up one day and decide that they will. I'm going to go to a chart of the Fed's balance sheet in a moment. Now, the rest of this stuff, I don't buy into. Jeremy Grantham is a very smart guy, but he's also to the left wing. And I agree with him on the very, very short term. You're seeing drought around the globe. This happens. This happens. So I'm not in the camp of saying that this is a macro climate event. So I'm not going to go into longer term problems. I think that we got to stick with what the problems that we have, because they're significant enough to send this market lower. So we have inflation. We have a tightening of the Federal Reserve. We have Ukraine. We have the Israelis. 2 strikes in Damascus and Aleppo. They're ratcheting up. They're threatening over Iran. Taiwan just went Connecticut. Taiwan just shot down a Chinese drone. I'm not saying they should or shouldn't have. I'm not passing judgment. It's not up to me. They got to do what they have to do for themselves. But ultimately, it's going to drag us in. It's going to affect the rest of the globe. So they went kinetic first. Taiwan shoots down drone off a Chinese coast for the first time. So the gloves are off. It's official. And nobody's talking about this. I don't know why. It should matter. So going back to, the margin call clip here, I say tongue in cheek that bad news is good news for the market. Yes, short term it is for a short covering rally. But once you start seeing U.S. manufacturing contract, we had the August print came out at 51.5. Now, that's the weakest since July of 2020. If that number drops down below 50, that is a signal of contraction. Right now, manufacturing is still expanding ever so slightly in the United States, but the globe is slowing down dramatically. So we need to keep an eye on this, because on the longer term trend of you have manufacturing trending down below 40 or 50 and getting weaker and weaker and weaker. If you're not going to produce and sell goods, how can you justify these valuations? Overvalued. You can't. Market's got to correct. And add to that, you have the services sector in the United States has already gone into contraction. We're below 50. And the services sector is a larger sector of the economy than what is manufacturing. So going back to that clip, the music is slowing down. It hasn't stopped yet. But when it does, things are going to get real fast. That's taking another clip out of margin call. So let's go to comments. Yoga Mac. Good to be here, Contrarians. Lovely day today. Absolutely. Every day above ground is a good one. Mom and pop shops, they want to play the bounce. Too risky. Go low and go long. You got it. Seymour, Lewis, sorry about that. I didn't get that link out today. I apologize. That's why I have so few people on today. Markets are closed Monday. Yes. Bob, will you consider buying SQQ again tomorrow? Probably not. Probably not. If we get a massive short covering rally tomorrow morning, then yeah. If they rally us up and into a resistance level that looks like it's going to get defended by shorts, then yeah, I'll reopen a short position. Right now, I'm not in a hurry to go into the weekend short of the market. And honestly, that's one of the reasons why I covered in advance of the weekend. I saw opportunity. I saw plenty of liquidity to get out at a good price today. I did. We're out. We're flat. So we'll see what Tuesday brings. But if we get a counter trend rally here, which is quite possible, I'll look to reshort the Qs, no doubt about it. And again, we'll go late dated put options and buying the SQQQ. And it worked for us this time around, and we'll probably do the same thing again. Whatever you do, don't go buying short dated puts or out of the money puts. Please don't do that. Please don't do that. That's a bad strategy. The odds are against you. That's why I make money selling premium, is because of people that buy out of the money options, and it's really, you're losing money. I'm telling you, I live by probabilities in the options game, and that's how we remain consistent, is probabilities. And I know the probabilities of you making money, it ain't good. So try to stick with a strategy of buying a deep in the money put option and then simultaneously selling a deep out of the money put option. That way you finance the trade and you have a lot of time decay, a long time before time decay kicks in, assuming that you buy leaps. You're going out minimum 90 days, ideally 180, even longer. So that way you don't have that theta decay, that time decay eating away at your investment. You don't worry about it. So I didn't mean to get off on a tangent there, but yes, I'm going to be looking to reshort the market. The lovely Trish. Welcome, Trish. Great to have you. Hope all is well with you. Westlaw, if SPY forms low lows on a weekly chart, 362, the selling is not over, but that is less likely to happen. I assume U.S. economy is in better shape than the world economy. Yeah. Yes, it is. And that's why you're seeing the dollar stronger versus the euro and the yen, but we're slowing down. Bob, Republicans are worse, unfortunately, because they have no spine to oppose, or they are playing on the same team. Well, yeah, I don't disagree with that. You have Rhinos, for those not familiar, RINO, acronym for rhinos in name only. They're the worst human beings on the face of the earth. They're either spineless Republicans or they're Democrats who ran as Republicans and they got elected. They fooled the people. So I think the people are watching a lot closer now. And yes, you're right. I mean, let's face it, America loves a winner. And the reason why the Republicans are so loathed is not because they are mean people per se. It's that they don't fight. At least the Democrats, those son of a guns, they fight. You have Mitch McConnell come out the other day who supposedly wants to be the leader of the Senate again, talking down about the candidates running for Republican Senate. Think about that. You would never see a Democrat do that, ever, ever. At least they hold the line. Republicans, as milquetoast as they come, the Mitch McConnells of the world, they got to go. They have to go. Thank God we got rid of Liz Cheney. Thank God she's gone soon anyway. The other guy that's on the January 6th, Kitzenberg, whatever his name is. I can't, Adam Kitzinger. I had a couple of Twitter wars with him. I stopped following him because I just can't stand his face. So, yeah, they got to go. So the economy, the reason why you're not seeing massive sell-offs right now, a la 2000, a la, or circa, I should say, circa 2007, 2008, you haven't seen the bottom fall out of the economy yet. It hasn't happened. It's weakening, no doubt about it. It's like an iceberg, but the melt is melting a lot faster now. So when we take a look at the issues that are, do I want to talk about this? Yeah, we do want to talk about this. All right, so this has to do with what I was going to go into anyway. The straw that breaks the market's back. And I go over this a lot. Every Thursday night, guaranteed I'm going over this. And that's the Federal Reserve's balance sheet. Now, the Federal Reserve can do a couple of things with their balance sheet. They can either sell the debt off their balance sheet, or they can allow the bonds to expire worthless. But normally what they do is if a bond expires worthless or it expires, I'm talking as an options trade right now, they'll just buy a new bond and they keep liquidity in the market. So once they stop buying those bonds and rolling over that debt, things start to happen. You have more debt that's in the market that's looking to be bought up by anyone other than the Federal Reserve. And let's face it, the biggest player out there in the debt market has been the Federal Reserve ever since China stopped being that number one buyer of treasuries. The Japanese are still in there, but we're using rat holes over in Europe to buy up debt and going into the Fed's balance sheet. I forget what country it was. It was some tiny country in Europe, and they were like one of the biggest bond buyers one month. I was like, what the heck is this? It was the CIA buying bonds for the Federal Reserve. Anyway, you could see that the Federal Reserve's balance sheet from last week began to roll over yet again. It rose last week, another lower high. And this is what I've been talking about, is that while the Federal Reserve has not lived up to its talk about rolling off debt off of its balance sheet, $30 billion, $20 billion, $20 billion a month in rolling off of debt off the balance sheet, they haven't done that. But what they have done is they've begun a trend. And the rate of change of that trend, meaning the rate at which they're beginning to roll off debt off their balance sheet, is beginning to ramp up. And you could look no further than that ramping up, no further than this chart here. Here is the 10-year yield. I warned about this breakout now over a month ago. I can't believe it's been a month. I warned about this breakout. It was probably on a Sunday Night Futures Live. And I warned, beware this breakout. This is when we went short of the market on this breakout. And I said that the correlation between the triple Qs and interest rates, the 10-year yield, which this is here, the 10-year yield, I should have said that. That would have helped. Is inverse. Once you get up to a 3 handle, back then we were still below a 3 handle. Once you get up and into a 3 handle on the 10-year yield, you're in that territory with tech stocks. They don't behave well. In fact, they convulse. They want to go down. So right now, we may see a bit of a reprieve and a rally tomorrow, because where do we close out the week so far on the week? 1 trading day left to go, right at resistance. So we'll see whether or not we get a pullback tomorrow and they allow tech stocks to rally. I would like to see a pullback on the 10-year yield. I would like to see a rally in tech stocks, so that way I could reload on shorts. So let's see how we closed out the day today. I'm not done with that last chart. I want to go back over. We may fill the gap that opened up this morning. No guarantees here, but we may fill that gap. All right, so really quick, when you go back to, we'll come back to these in a moment because I'm already long-winded. I always do this. I don't leave enough time for chart requests. I just want to go back to this. So these are the Fed tightening cycles and how they end, folks. This is just reality. And, you know, this was not so much of a Fed tightening event here. This is more of a deficit. The 1987 stock market crash was when we were really focused on, we were a creditor nation. We were a gross net exporter. We had really no debt per se. Sure, we were building up a deficit after Reaganomics, but it was manageable. But we reached a point where we were so fiscally conservative that deficit really bothered us. Now we get deficit reports that come out $50 billion a month. We don't even pay attention to them anymore. We had a few reports like that back then, not $50 billion, but in 1987 terms, it was a lot of money. So that's what caused the stock market crash. Then you had the S&L crisis, and then, you know, these tightening events, they're looking for a pin to burst the bubble. And unfortunately, this time around, it's going to be the debt itself that's going to do it. So buckle up. This is not going to end well. You'll know when it's over when we have a VIX that has seen a blow off top. And you remember, you can go back to my June live streams. I was asked a bunch of times, is this the bottom? I said back in June, I never changed my tone, not one single time, that I did not believe that the low is in for the equity market, because unlike every single in every stock market drop, you never had a blow off top on the VIX. Back here, 2002, we hit a 45 handle. That's the lowest. Back here, 2008, that's the financial crisis. We hit 89.5 on the VIX. Back here, 2015, 53. Back here, COVID, 85.47. June, where were we in June? The high was 35. That's not a blow off top. That's not even the minimum. The minimum is back here at 45. So there's still way too much excess. And unlike other bubbles where we bottomed out, the stocks were undervalued, or at least fairly valued, before they took that next leg up because of the Federal Reserve loosening up the spigots yet again. There's no sign of that right now. We're expensive. The Fed is tightening. Inflation is here. Energy is still strong. Pricing is still strong. And Europe is in a lot of trouble, unless there's a peace accord over in the Ukraine. If there's a peace accord in the Ukraine, you're going to see the dollar go this way, the euro go this way, oil go down along with natural gas. So that would be a huge, huge reprieve for the globe. But have no doubt about it, folks, we are in the midst of World War III. The only thing that's missing is is partially the kinetic portion, meaning guns are being shot off, except for the Ukraine. But what is the impact of the Ukraine on the rest of the globe? It's profound. It's profound. In one way, we're already feeling it: energy, food. The other way that we haven't felt it yet is with the US dollar. Remember what we have done here. If they sign a peace accord over in the Ukraine, Russia's going to keep, no matter what, it's over. It's done. They're going to keep that eastern section, the Donbass region. They're going to annex it, or they're going to make them a couple of republics. I have no idea what they're going to do. Either way, they will not be Ukrainian. They will be Russian. Once they sign off on that peace accord, you're going to see the dollar. I predict that you're going to see the dollar take a nosedive, a massive nosedive. And it's not going to be from a low level either. Because if you take a look at the US dollar, which spiked up today, and frankly, it hurt me on my silver position, gold position. If you want to buy gold, man, it's 1,700 an ounce right now. You got to look at it. At least nibble. Physical, not electronic. Physical only. Don't buy that Comex junk. Here's the US dollar, which I do believe is going up higher. Here's the US dollar. Look at this rally. We are about 13 bars extended beyond the 50-period moving average. The high that I know of last was 17 bars. That went back here. Actually, no, back here. 17 bars beyond the 50-period moving average. We're very, very extended. And this did not end well. So I don't think that this is going to either. In fact, if they sign that peace accord over in the Ukraine and that war comes to an end and the natural gas and oil starts flowing along with wheat, etc., you're going to see the dollar take a nosedive. And then you're going to feel the real consequences as an American. The Europeans are feeling it right now. Weak euro, high energy and food prices. As an American, that's when the war comes home to us. Because the Russians are no longer on the SWIFT system. They are forming their own currency along with the other BRIC countries, which makes up 3/4 of the global population. Think about it. The dollar is the world's reserve currency, is still stable until it's not. And wait till traders start to price in the new global order. It's going to be vicious. So, got gold? It doesn't look pretty now, folks, but now's the time you need to be nibbling on it. Now is the time. And by the way, we have our gold mining stocks. I sold a ton of covered calls going out into early October. So we're selling the covered calls on our positions. All right, what else are we doing here? Let's go to the weekly charts. Let's blow through these. I want to get to chart requests. We went over yields. They're going up higher. Folks, the bond price, the 20-year bond price, this is a catastrophe. So remember, this is the bond price. If it goes lower, where yields going, they're going up this way. That's no good for equities, especially tech stocks. The bank stocks like it. They'll do fine. What won't do well? Semiconductors, especially now with the threat of the U.S. government banning exports of semiconductors over to China. This is a whole new dynamic. This is why I do not invest in Chinese stocks. There's going to be an economic war soon. It's already begun. It's already begun. So we have broken down below the lows of the prior week. The prior week, folks, was a bullish key reversal bar. Normally in a bull market like back here, you would have seen a breakout the next week. What happened? We took out the lows. This is a signal to bulls. Bull trap. You got suckered in. So whatever you do, when you see a candlestick in a bear market that's a bullish reversal bar, you got to set a stop right below it. Because if it fails the next week or the next day, wherever your bullish candlestick is set up for, daily, weekly, monthly, doesn't matter, 15-minute, if the next bar, you take out that low, you got to get out. Because that's a negation of the prior move, and it's a magnification of just how weak the market is. So the bond market, bear market is alive and well. What does that mean for yields? They're going up. Tips. Now, here I think that there's an opportunity. The tip market is falling apart. Why? The Federal Reserve is going to come to the rescue of the market. They're fighting inflation, but they're also going to pivot very, very soon. So we're not worried about the pivot right now because I think that the Federal Reserve is going to fight inflation. Therefore, why do I need tips? Okay, tips are on sale. What are they? I wouldn't buy them now, but what are they yielding? 7.5%. Not bad. I wouldn't buy them yet. I think they're coming back down here to 110, and quite possibly they could break. We're in a bear market. We're in a bear market. The dollar, we kind of already went over here. New weekly and new monthly higher highs. The path of least resistance is higher here. The only possibility is that you get in lieu of a Ukrainian peace accord or a ceasefire will do it. The euro, the only thing that'll stop the euro from going down is the ECB raising interest rates by 0.75 of a basis point. I mentioned this last Friday when the Jackson Hole news came out, that the news wasn't with the Federal Reserve. The real news, which nobody paid attention to, was the ECB floating that they may be raising interest rates by 0.75 of a basis point. Now, what happened this week? No new lower lows. No new lower lows. Yet the dollar continues to press up higher. Why? Because the yen is still very, very weak. And the euro is down on the week as well. The yen this week and on the month now, we have new weekly and new monthly lower lows. So these currencies are basket cases. I don't have much hope for the yen at all. But Europe, I'm telling, if you wake up one day and you see a ceasefire over in the Ukraine, you're going to see the euro rip through the ceiling. You're going to see oil, natural gas go in the opposite direction. And you're going to see the dollar swoosh. Winter's coming. And those backstabbing weasels over in the EU, you could bet your bottom dollar that they're having private talks with the Russians right now. And it'll just hit the news like that. All is done. Zelensky also came out that he spent the month of August with his wife in a villa. I think it's like a $10,000 a month, which is not that much, I guess. But it was an expensive villa in Italy. He got outed. All right, so the VIX market, the VIX is flat on the week. I find it shocking because you have the S&P 500, which is down 2%, and the VIX is flat. It's the most bizarre price action. I've been talking about this for weeks now. I don't get it, but this is just a sign. I guess I do get it. It's just a sign that you don't have enough fear in the market yet, meaning going back to that manufacturing report that I mentioned earlier about it being above 50, you see that number come out below 50, equities may rally, but guess what? The VIX is probably going to rally as well. Traders will buy the stocks on the rally, but you know what? They're going to want some insurance as well. You're seeing the inverse right now. Things aren't bad enough to bid the VIX up, but wait till the bottom falls out of the job market, out of manufacturing. That's when things get real fast. I keep using that phrase tonight, but I'm trying to drive a point home. What else do we want to go over? Qs. Again, we covered our shorts here. We hit support. We took advantage of the liquidity. We're out of this. When might we want to get back in? I think a rally up to 309, 307. That'll get us back into the short side on the Qs daily chart. Bullish key reversal on the session. We got out fairly early on the day today. So I'm glad we did. We got out on the put options at around $300 a share. And then we covered the SQQQ at around the lows of the day today. The banks. If there's any one sector that should be doing okay right now, are the banks. Now, one of the other issues that are out there, nobody's talking about, is that you have a used car bubble that is out there. And the banks they're hoarding repossessed cars. They don't want to put them all up for sale because they'll crush the market with used cars. You want a new car? Wait a year. Wait a year. There's going to be used car prices are already rolling over. I knew this from 3 months ago with the Manheim auctions. I looked at the chart. They were rolling over. It didn't hit retail until now. Used car prices are starting to roll over. Wait until next year to buy a new car. You'll buy it used, but you'll get a great deal because the banks are going to be giving them away. Technology hit support, bounce today. We have a breakout point failure here. We broke out a few weeks ago, broke back down. The trend is alive and well, and that trend is down. Semis, I don't think you can buy these. I don't know. I'm not that educated on what companies sell what kind of chips to China. And apparently we're going to put some restrictions on those companies. So I'm going to avoid these names, unfortunately. And I love NVIDIA as a trading vehicle, but I have to avoid it now. LEB, we have a small position here. We have a bullish reversal bar on the week. We booked our profits a few weeks ago now. 3/4 of our profits we took off the table. And now we're looking to re-enter. The trend is still good. RSI moving up higher. Bullish reversal bar, always nice to see. One trading day left to go. We'll see what happens. Let's go to a daily chart. How do we close out today? Bullish reversal bar, also known as an outside reversal bar. If you're not familiar with the terminology I'm using for these candlesticks, link below my top 5 favorite candlestick patterns, free 5-part video tutorial. Also link below is a video on what a strangle is. When you hear me talk about them, I mentioned them earlier with our Broadcom earnings trade and our Lululemon earnings trade, video below on what a strangle is, how we trade them anyway. You could be long or short. I like to short them, meaning sell premium. Consumer staples, off the lows of the week. They were real ugly last night. We're just about the 50-period moving average. Come on. There we go. Discretionary names, off the lows too. Less worse, I believe. No, not quite. So they're off the lows. How did these close? Volume is light this week. Very, very light. Nice reversal bar today. Lululemon may help drive this sector up tomorrow. I think I'm going to do a video on Lululemon. That trade and the stock. All right, let's talk about gold. Let's look and see how we closed out the month because it was not pretty. So on the month last month, gold flashed a bearish key reversal bar where we opened lower on the session. We did rally off the lows of the session today. But folks, we gave up a support level. I mean, if we don't gap up tomorrow and close out the week above 1720, gold's in a lot more trouble than what it is at current. I mean, it's not looking good here. That dollar is hurting gold. So if you're gonna buy gold, buy in increments, dollar cost average in. I don't know where the bottom is going to be here, and that's the reason why I'm on my gold mining trade. I'm selling deep out of the money covered calls, going out over 30 days. Normally I wouldn't do that. I'll just sell the front week and collect a few $100s on the position. But this time around, I said, you know what? I want to go as deep out of the money as possible, collect a reasonable premium on those options, and allow me to defend the trade. So that's what we're doing. A little bit of change in strategy, but it's warranted. Now, as for the gold mining stocks on the week, I mean, they're just falling out of bed. Nugget hit new multi-year lows today. Daily chart. We're due for a bounce here, but we're seeing a lot of distribution. Now, this is a leveraged ETF. Obviously, it's a trading vehicle. So we'll take a look at the GDXJ, which is also breaking down, is broken down below critical support. Stokes rolling over. That higher low that we were looking for on RSI and on stochastics has failed. One trading day left to go. Maybe we'll see a massive rally back, but I doubt it. So avoid these names right now. Avoid them. Now, we're long of natural gas using Boyle, and we're at the pinnacle or the apex of a triangle formation. We could be breaking out here very, very soon on natural gas. It was up today. I think we closed off the highs. Yeah, we did. Stokes are down below 50. Be careful here, or they're at 50, because rallies tend to fade once you get down below 50. And you're already beginning to see that. So just keep an eye on natural gas. I'm bullish on it, but I'm a little bit wonky right now, a little bit cautious on it. Even though you have the crisis over in Europe. If they're sniffing out a peace accord over in Ukraine before winter hits, these guys will sniff it out. So if you see weakness on natural gas prices, there's a probability that you're seeing some sort of a peace deal occurring over in Europe, and the word is out. So those are the charts for the week, and we will go to some chart requests. Pops and Fuego, yeah. That should be a shirt. Zaki, can you please remove the comment covering the bottom of the screen? Sorry about that. I hate that too. Sometimes I watch the replays and I see that I do that. So my apologies. Point well taken. I'm still a host in need of a producer. If there's a producer out there you want to work for cheap, let me know. Help me out. And yes, I think Yoga Mac is probably the best one right now to be a producer. Like, subscribe to the Bob Desmond, the Contrarian Trader. Go for it. Thank you. Yoga Mac, the man. Like, subscribe, and hit the notification bell. Bob should do a show opposite Kramer. Damn, buddy. I may do a commentary on his shows. That's a good idea. I may do that. You know how they some YouTubers, they comment on other people's commentary. Avago. We already went over Avago. Broadcom. Zaki, we did the trade, the earnings trade. We can take a look at the chart. I mean, let's go over to our friends over at TrendSpider. They're the sponsor of the show. 35% discount code below. TrendSpider, automated technical analysis. If you're not using it, bad. AVGO. So I didn't draw this line here, right? So is it any irony that we bottomed out right on top of this green line? What's this green line? It is a algorithm support level on a monthly time frame. Now you see it, now you don't. There's multiple, a bunch of them. So we hit monthly support. They reported earnings today and they rallied. Does the support level hold? I mean, it's only the first of the month. We're going to get a rally tomorrow on Broadcom. Will it last? I don't know. I don't know, right? It all comes down to market sentiment. I think that honestly, a lot of these names, in particular the semiconductor names, you got to look to short the rally. I don't want to be that guy, but I am that guy. You got to look to short the rally, because what the market is doing is, God forbid, this morning you woke up and you were shorting the Tues at the lows, predicting that you were going to get a massive sell-off. That's no way to short. That's stinking thinking, as alcoholics say. That's stinking thinking. What you need to do is to get your crayon out. I wouldn't use a monthly chart on Avago. I would use, they already did it for me. So in the after hours session, I keep saying Avago because I always forget that they merge. Here's AVGO. Last tick 503, right? So where's 503? We're going to open up tomorrow. Even though we have a gap up in the after hours session, we're going to probably gap up tomorrow morning. We're going to still have resistance up at 511.19. I didn't make it up. That's what the algorithm's telling me. I'm going to be looking to short Broadcom at 511, maybe 512 on an overshoot to the upside, possibly tomorrow, and taking advantage of that rally because I don't think that it's going to hold. So thanks for the idea, to be honest with you. I wasn't thinking about doing it. We covered silver yet? No. Silver's cheap. It's dirt cheap. You got to, no, I'm not short it, so I didn't cover it. Did I sell mine? No. Did I buy more? No, not yet. Back to Broadcom. It's due for a counter trend move here. Resistance up here for a big rally. If it goes up to 521, that's going to be a beautiful, beautiful place to short. So I do think we're going to rally on Broadcom, on the market in the next couple of days. What else do we have? Let's bring up silver since the gentleman brought it up. I mean, have you looked at the silver chart? Ha ha. Oh, I'm sorry. Now I understand. Okay, I apologize. I misunderstood. Thank you for the clarity. Yeah, so silver, honestly, right now on this chart, if you would have asked me, hey, listen, would you want to go buying silver tomorrow? I would have said no. No, no, no. Looking at the chart here, it looks pretty god darn good on a daily time frame anyway. Why? We hit support today. I did not know this until I just brought it up. So thank you, Matthias. But we do have resistance immediately above. So I wouldn't buy it. I wouldn't short it. I would wait to see how this gets resolved. Do we gap up higher tomorrow? If we do and we close above resistance, okay, you can buy it. If we trade back down below to this lower band of support here at around 16 on the SLV, then you can buy it, but you got to use a tight stop immediately below because what is your enemy? You got to know what your enemy is with this trade. And your enemy is this, the US dollar. It is parabolic. It wants to go up higher. It probably will go up higher. Case in point, all you need to do is take a look at the hourly chart of the dollar and how it closed out the day today. Here, bring up UUP. I mean, we were overbought relative to the 2 and 3 standard deviation Bollinger Bands, but the pullback did not result in a pullback that filled the gap. It was a pullback that resulted in a consolidation and a setup, which probably means that we're going to move up higher tomorrow morning. Let's see what they're doing in the after-hours session with the dollar. And believe me, I want to be wrong, but it doesn't look like I am. They broke it out in the after-hours session. So you can see here in the gray area, this is the after-hours session. They drifted it out. This is on light volume, though. Let's be fair about that. Asia is not open. Europe is closed. We'll know by 9 o'clock, midnight, which direction the dollar is going to take going into tomorrow. So be careful. Dollar moving up, it's best just to stay off the train tracks. Don't go buying more. I agree. Looking to sell the dollar rally soon. Yeah, I'm just not seeing that reversal yet. I'm looking for the setup. I'll be honest with you. I did buy some December calls on Nugget today because the dollar intraday was so overbought, trading above the 3 standard deviation Bollinger Band. I expected a decent rally on NUGT intraday, but we did get a rally, but it was muted. I mean, it was horrible. Here, we rallied off the lows up to 24.29. It was a horrible rally. I don't even want to call it a rally. It was just a blip. So this is not a good looking chart. So just beware of these names right now. Please be very, very careful. And I may, before the weekend ends or the weekend begins, I may just take a loss on those options and get rid of them. So it's no time to really be long of call options yet. There will be a time. I thought we had a setup the other day. I was wrong. And I wanted to add more today to take advantage of an intraday rally and exit the entire trade. But it never happened. So we'll see what tomorrow brings. And with that, folks, everybody have an awesome night. Thanks for being here. It's always my pleasure. I am honored to be here. You humble me. And everybody have an awesome, awesome holiday weekend. It's Labor Day. You earned it. Have a profitable trading day tomorrow. And everybody be well.